The Strait of Hormuz is still closed, and a tentative ceasefire is fragile at best. And yet, global stock markets staged an impressive rally in April. We can call it a disconnect, or we can call it investor optimism for a peaceful resolution in the near future. Mixed messaging from the White House has been a leading source of volatility here. Progress is being made. The deal's off. We're close to peace. There's been an airstrike, and so on and so forth. Just this morning, word circulated that another deal is in the works. What matters is that shipping traffic to and from the Middle East returns to normal. Until it does, dominoes will continue to fall. The first is clearly rising oil prices, which hurt consumer spending and raise costs for businesses. If other commodities stay stranded in the Gulf for much longer, supply chains will need to grapple with more than just fossil fuel shortages. Fortunately, corporate earnings reports for the first quarter have been off to a strong start. Technology has stood out once again, as massive spending in AI infrastructure continues to power growth. Expectations for the coming year's profits have surprisingly risen since the start of the Iran war. The consensus now hopes to see growth rates in the high teens. The view is that rapid strides in AI will outweigh the higher energy and transportation costs that businesses face. We think skepticism is healthy, and while we believe in AI's potential, we have our doubts about how it could overcome a global crisis in the short term. It wasn't so long ago that the tech sector was brought back down to earth. In March, markets were fearful that AI would quickly displace enterprise software. While we felt that the sell-off was likely an overreaction, and if not, it was certainly premature, we have been surprised by the V-shaped recovery in the sector. The reality is that some businesses now have to grapple with the ongoing threat of AI. They often come as sudden breakthroughs after lengthy pauses. Those companies will need to adjust proactively to avoid displacement. On the other end, some businesses will thrive by integrating AI into their operations. This is bound to create ongoing volatility in the sector. It's also a key reason why prudence is necessary when weighing exposure to a single theme. On that note, we are again becoming wary of the concentrated nature of the US market indices, with the top 10 stocks approaching 40% of the S&P 500. In our experience, broader markets where different sized companies, various industries, and more securities are participating in growth make for a healthier investment environment. While equity investors have taken the conflict in the Middle East in stride, the same cannot be said for the North American bond market. Yields are now higher today than at the start of the year. This was not expected by virtually anyone. The cause is likely oil and natural gas prices climbing globally, which will feed through to higher inflation over the coming months. While the Bank of Canada and US Federal Reserve often ignore these one-time factors, they are becoming more concerned about secondary pass-through effects. We are already seeing these effects in some market segments and everyday life. Higher airfares and fuel surcharges on deliveries come to mind. All of this is to say that the assumptions investors held to start the year have quickly reversed course. Interest rates were expected to fall, but now some worry over potential hikes. Setting higher interest rates would be a big pivot. We expect the status quo of holding rates steady to continue for the next few months at least. Policymakers will reassess as more details emerge, and as portfolio managers, so will we. Kevin Warsh has finally been confirmed as the new chairman of the Federal Reserve. He's aired concerns over past committee decisions and procedures, so changes are to be expected under his official leadership. So what happens to his predecessor? Jerome Powell will continue to serve as a governor until he is confident that political pressures have not compromised the Fed's independence. While the new chair appears to have a bias towards lower interest rates, it is clear that the committee's consensus is leaning the opposite direction. Although he's the chair, he still only has one vote to cast. Longer-term bond yields have already experienced some upward pressure due to rising government debt levels, something that has been worsened by the cost of the war and the Supreme Court's ruling against tariffs. The US cannot afford to let yields go even higher if bond investors fear that the central bank will be less committed to fighting inflation. The end result is that bond investors have experienced meager returns to start the year. But keep in mind that fixed income securities should remain an important component of an overall portfolio, given the uncertainty that equity markets may face in the months ahead.